Good morning, everyone. We are Team L, and I am Prem. With me, I have Carolina, Mark, Colin, and Martin. We issue a hold recommendation for Genuine Parts Company, otherwise known as GPC, with a target range of 117 to 145. We acknowledge the recent market pullback, but because of geopolitical risk and interest rate hikes, we still believe the stock warrants a hold. Our recommendation is based off of 3 key points: attractive dividends with a yield of 2.7%, high financial leverage limiting inorganic growth, and flat margins despite a 4.4% expected revenue growth rate. I will now hand it over to Carolina to discuss the business highlights.
Thanks, Prem. GPC has a wide geographical reach in North America, Europe, and Australasia. It distributes, wholesales, and retails replacement parts in the automotive aftermarket and industrial supplies wholesale industries. The automotive segment comprises 2/3 of the company's total revenues. Also, GPC primarily operates in North America, but it has expanded both segments into Australasia and its automotive segment into Europe through acquisitions. Through distribution centers, stores, and replacement parts, GPC is able to offer its services and parts to a variety of customers. The automotive industry is a complex structure, allowing many access points for new entrants. I will now hand it over to Mark to go over the investment thesis.
Thanks, Carolina. I'll now elaborate on the investment thesis regarding attractive dividends. GPC is celebrating its 66th consecutive year of dividend increases in 2022, and the company recently announced that its dividend per share would increase by approximately 9.8% to $3.58, giving investors a dividend yield of 2.7%. We believe management's guidance of a 7% increase in its DPS is in line with its 10-year CAGR. In 2021, the dividend payout ratio was within management's 50 to 55% sustainable outlook. With dividends making up 34% of its capital deployment, GPC also repurchased 2.6 million shares in 2021, and the company recently announced that it will continue share buybacks in 2022. With capital expenditures, we believe capital expenditures will increase by 30% in 2022 as it expands its operations in international markets. Now, GPC's high financial leverage limiting to inorganic growth. For the past 11 years, GPC's debt-to-asset ratio has grown at a compounded annual growth rate of 12%, a debt-to-asset of 76%, which eclipses its peer average of 59%. We believe that this will theoretically constrain the company's ability to grow in the future. With 60% of the company's growth driven by acquisitions over the past 5 years, we believe this will materially slow the company's ability to grow. Next slide. Since 2017, the company's net depreciation has continually increased. While we do acknowledge that for the past 2 years, capital expenditures have been higher than depreciation, historically, capital depreciation has been lower, or capital expenditures have been lower. I'll now turn it over to Colin to expand on the implications of its tighter margins in international acquisitions and its growth.
Thanks, Mark. GPC's international acquisitions provide the company with its primary competitive advantage: economies of scope and economies of scale. As seen in the rightmost graph, companies with higher total assets also derive a higher return on assets, indicating a significant benefit for GPC. That being said, in GPC's primary North American markets, we have identified 4 key competitive metrics: the time it takes customers to reach an auto parts store, the number of replacement parts customers can buy at those stores, the percentage of cashback returns customers can get on those purchases, and the percentage of customers that describe themselves as loyal. GPC outperforms its peers in none of these key areas, and in fact underperforms AutoZone in each of them. This lack of competitive edge provides a downward pressure on GPC's operating margins and drives the company to have a lower return on assets than the average of its peers. Moving on to growth, GPC's international expansion exposes the company to markets with significantly higher growth potential than in North America. And we believe that this exposure will provide GPC with a sustainable source of organic growth and significant tailwinds for years to come. Although we expect GPC's revenue to grow by 4.4% annually, we also expect margins to remain stagnant due to accretive SG&A costs from the company's bolt-on acquisition strategy and increasing competition in North American markets. I will now pass it over to Prem, who will elaborate on the implication of these projections in our valuation models.
Thank you, Colin. We use 6 different valuation models to derive our target range of 117 to 145. We use the dividend discount model, residual income model, discounted cash flow model, LBO model, public comparables, and precedent transactions. Please note, we use precedent transactions and LBO model because of the high M&A activity within the firm's industries. On the football field on the left, you can see the respective ranges for each model. Additionally, we would like you to note that our target range of 117 to 145 was affirmed by our Monte Carlo simulation, in which 100% of observations fell within that range. We also performed sensitivity analysis for both DCF and DDM. We varied the growth rates for both models, and we varied the cost of equity for DDM, and we varied the WACC for DCF. I will now hand it over to Martin to discuss ESG initiatives.
Thank you, Prem. As seen on the left, GPC has historically had high ESG scores compared to its peers, representing a higher risk driven by high governance risk, as seen on the right. GPC has achieved several environmental achievements, but it still has an opportunity to improve its environmental score by initiatives such as reduction in fossil fuels, which currently account for 63% of its energy sources. From a social standpoint, GPC started a diversity, equity, and inclusion council that has made many initiatives such as hiring and promotion of females and minorities to managerial positions, and women as Napa Auto Store owners. To assess governance risk, we use the ISS DSAL scores. The high audit score of 7 is driven by issues in its internal controls, financial reporting, critical audit matters, and also 2 of the finance executives had recently left the company. The high compensation score of 8 is driven by the presiding independent director acting as the compensation committee, head of the compensation committee. In relation to shareholders' rights, GPC can issue new equity without shareholders' approval. Also, the CEO acts as the head of the board and the executive committee and has the power to act on behalf of the board, contributing a high score of 7. The increase in ESG scores, the lack of public commitments and environmental targets, and high governance risk reinforce our whole recommendation. Now Carolina will continue with investment risks.
GPC's growth is premised on mergers and acquisitions. They risk synergistic benefits associated with inorganic growth to finance debt, and it may not be fully realized. They also face supply chain issues regarding inadequate talent. We use the Pastel framework to analyze GPC's external risks. For political, GPC may face a 15% global minimum tax. Also, GPC's stock price may become volatile due to geopolitical events such as the Ukraine and Russian crisis. For economic, current high inflation reduces consumers' purchasing power, and expected interest rate hikes reduces GPC's capacity to borrow at a favorable rate. Finally, for environmental, the global community is becoming more cognizant of climate change and environmental challenges, resulting in countries supporting new environmental regulations.
1 minute remaining.
We use the risk matrix to highlight the probability and impact of each risk on GPC. We believe interest rates pose the greatest risk to the company since it could hinder GPC's ability to acquire debt. We issue a hold recommendation for GPC due to its attractive dividends, high financial leverage, and revenue growth but stagnant margins. Thank you, and we are now open for questions.
Thank you, Team L. Judges, please come ask some questions.
Thank you. I'm interested in how your projections of what's going to happen with the mix of electric vehicles versus ICE is going to impact their growth rate and their profitability going forward.
So speaking on that, our risk matrix assesses that the risk of the rise in EVH is what we abbreviate it as is very low, right? 12 to 16 months forward. But because of the increased dependence or increased projected dependence on electric vehicles, maybe 10 years out, we believe it poses a huge risk in terms of revenue headwinds. This is because Tesla currently only allows Tesla mechanics. Only Tesla mechanics are authorized and trained to work on these cars, and their parts are also patented, so you can't buy them from anybody but Tesla, and they're not even open for retail.
But wait, wasn't that at the bottom end of your risk matrix?
Yes, so the risk matrix is 12 to 16 months forward. So the risk of EVH is deemed pretty low 12 to 16 months
This
forward.
is short-term.
Yes, that's a short-term risk. But over the long term, maybe 10, 15 years in the future, we think that EVH, the rise of EVH does pose a considerable threat to GPC and its competitors.
How did you
Yes, sir.
factor that into then to your valuation of the company when you think about terminal values? Because the value of the company is obviously not based on what's going to happen in the next 16 months. It's going to based on what's going to happen over the next 16 or 30 years.
Yes, so we used a modest growth rate of around 3.5%, which actually is in line with GPC's historical cash flow growth. In addition, that 3.5% was the growth rate of the U.S. economy as dictated by the IMF. And so we don't believe that GPC will grow faster than the economy. So that was our growth rate in the terminal periods.
Can you talk a little bit about the expenses in the model and how you came up with that?
Yes, so a lot of the expenses in the model were based off of projections of increased M&A activity within the next 2 or 3 years. So as Colin mentioned, there were accretive SG&A costs that were taken into account into our model. And we believe that's fair. GPC is still one of the biggest auto parts and industrial parts wholesaler in the world. So we think that they do have the ability to keep acquiring companies on a smaller scale.
So what was your long-term expense growth?
I think our long-term expense growth was around maybe 2.1%.
I was interested in your competitive analysis. Could you go back to that slide? And you basically concluded that they weren't market leaders in anything. Can you talk a little bit more about that and why, how that impacted your analysis?
Yes, ma'am. So you got the point exactly right. We don't believe, at least in the North American markets, that GPC is a market leader, especially with Napa stores in its auto parts segment, a market leader in anything. Actually, I have a further breakdown down here. And yes, this exactly the point that because they don't have market leadership in anything besides probably having the best website, we believe that there's significant pressures on GPC's margins.
Thank you.
You used 6 models to value the stock. Did you place an emphasis on any one or more of the models?
We placed an emphasis on the dividend discount model, of course, because dividends are GPC's bread and butter, and then of course the discounted cash flow model, because we believe that these projections should be valued at what they are. They're projections, but they're important projections. Of course, the public comparables we valued at 20. We weighted it at 20% also, but the emphasis should be on the dividend discount model and the discounted cash flow model.
So could you unpack the DCF model for me a little bit and go through your assumptions and sources of those assumptions?
Yes. So our beta of 1.09 for the cost of equity was actually derived using regression analysis and of course covariance matrices, etc. We had a cost of equity of 10.6. The market risk premium used in that CAPM derivation was 8.4 with a risk-free rate of 1.5. Additionally, can you go to the slide before this? We weighted debt and equity at equity and debt at 60-40 respectively, and additionally, our after-tax debt was actually 1.76%, and that led to a WACC of, as you can see, 7.75%.
Are those weights actual market weights, actual company-specific rates, or are those assumptions that you made on your?
We made assumptions. Going forward, we think there might be a possibility of equity dilution because of the share repurchase, or equity accretion because of share repurchases, and additionally because GPC is going to engage in higher M&A activity, so we do believe that they'll finance that activity with debt.
And your leverage issues, did you look at the coverage ratios? What's the coverage ratios?
Yeah, actually GPC had a pretty high coverage ratio, I believe in 2016. Let me go back to the appendix returns. So as you can see here, it was actually 2017 where they had a zero interest expense. The company's interest coverage ratio generally is around, I believe, 2 or 3. Of course, when you have companies like AutoZone and LKQ and AIT, of course, if we were to isolate this, you can see that GPC predominantly underperforms compared to Advanced Auto Parts and, let's see, including MSM, which is more of a industrials company, industrial parts company.
Can we go back to that slide that you showed showing the sensitivity analysis to your inputs on your
Yep.
valuation model?
No problem.
Where was that? We
Right there.
blew right by that. Maybe talk a little bit about how you factored this sensitivity into your thinking.
Yes, ma'am. So I'm going to start with the growth rates. Of course, I explained the terminal growth rate of 3.5%, which was in line with the historical average of GPC's cash flow growth, but also the sustainable growth rate for the DDM was actually dictated by management. They hope to, increase dividends at 7% per year. Additionally, the 7% is not far off from their 10-year CAGR of 6.1%, as Mark explained earlier. And then, of course, the cost of equity was derived based off of the CAPM model, and the WACC was, I described it earlier, with weights with 60% weight on equity and 40% weight on debt.
In your choice to use 6 different valuation models in your weighted average forecast price, did you consider to lower that number from 6 and maybe affirm some of your assumptions in 1 or 2 or 3 of the models that you thought might be more relevant to valuing this particular company?
So to be completely transparent, we actually started off with 8 valuation models. So we decided the best course of action would be to break the company up into 2 different segments based off of total assets. We also performed a regression analysis. I think Colin will pull that up. And so we wanted to do a sum of parts valuation, both with public comparables, precedent transactions, and discounted cash flow. So 6 was actually the number we decided on after we cut down from 8.
Can someone speak to a little more about the industrial segment, because it's a big chunk of their business and sort of end markets and growth and what the company strategy is there?
Yeah, I think we expect GPC to continue to expand their industrial segment because the segment offers a higher higher profit margins for the company than its auto parts segment, and additionally the industrial parts segment actually might be an area where GPC does have a competitive edge. The Motion and the other related brands offer more a wider selection of units for customers to purchase, and they have a very competitive number of distribution centers, meaning that they can reach customers efficiently and get them those next day orders with very high accuracy.
And to expand on that a little bit, GPC's industrial segment has actually performed better in terms of all the supply chain issues. Their refill rate, I think, has stayed pretty constant throughout the last 18 months, whereas the auto parts has, experienced a few supply chain issues.
We have 1 minute left, so let's just take one more question.
Could you discuss the ESG a little more? I'm interested in the trend. You did a good job of showing where they are now. What do you think of that? Can you unpack that a little?
Of course. So GPC's ESG vision is retrospective, so it doesn't currently have environmental targets, like I said. So we see that as a big risk since many governments are putting on regulations and guiding industries to go more to green environment. So we see a definite risk there for GPC.
Well, how are they doing though? How's their trend going? Is it flat, up?
It's increasing, as you can see here. So GPC's ESG scores have been increasing, meaning there's more risk to investors.
In addition, I'd like to note that we did a lot of research, and GPC has no public vision statement, like publicly available vision statement. So we think that's a little bit risky, especially when you're trying to guide employees in the firm. If there's no established vision, that might represent high risk for investors.
I mean, if we also look at the ISS scores, if you go to that page, we can see that the board structure of 7 is somewhat attributed, or almost entirely attributed, to Paul Donahue having a triality as chairman, as CEO, and then as executive of the executive committee, which can essentially do all of the responsibilities of the board without board approval. Of course, 7 for the audit is for the 2 critical audit matters, which were due to the valuation of its goodwill and its goodwill impairments last year. I think it should also be noted that, of course, Carol Yancey, who has had 15 years as CFO of GPC, recently departed very quickly, and we should also note that the Senior Vice President of Finance / their accounting officer also recently left 2 days ago. So whether this is tied in with those critical audit matters and that implication, GPC has some serious internal risk when it comes to talent in the future, as well as with the labor market being very competitive, and of course GPC essentially not meeting those compensation requirements for new employees.
Yeah, but didn't everybody get killed on impairment in 2020 and 2021?
Yes. So the problem here is not the impairment. The problem here is that the independent auditor issued a critical audit matter within the audit report, which doesn't signify a necessary, it's not necessarily an issue, but it represents high risk for investors, that those are the key areas that investors should probably look at and do more due diligence on.
And it should also be noted, these are intangibles and acquisitions, and we've seen that GPC continually acquires companies. If we look at the IP sector, they had 23 new acquisitions. So it's a big issue if we don't take into consideration these goodwill.
Good job, guys.
Thank you.
Thank